Hello, everybody. So today I want to talk about Crowdstrike's earnings and their full year 2023 results and their Q4. So Crowdstrike is continuing on its trajectory of very, very strong revenue growth. In fact, for Q4 of 2023, they reported $637 million, which is a quarter-over-quarter increase of 9.6% compared to the prior quarter and 48% year-over-year increase. This is actually very, very bullish for Crowdstrike. And, a lot of companies have seen kind of a curve in their earnings where Q4 is really down compared to Q3 and Q2, but they kind of hide it because they had a very strong Q1 and Q2. Crowdstrike doesn't do that, but they don't even report on their annual letter the quarter-over-quarter growth, which is outstanding for Crowdstrike. And if I were to make a prediction as to where it's going to be for the next 4 quarters, right, which is what I'm interested in. I'm interested in seeing that the growth continues. If I extrapolate that 9.63% over the next four quarters, that would be a growth of 38%. Annualized. So upcoming 38% growth annualized. But if you compound it, which is my better way to do it, that would mean that over the next 4 quarters, over the next year, we would see another 44% growth in the revenue of this company. So really, really outstanding revenue growth numbers. But you'll see that this company is a story that's all too familiar of a company guiding for GAAP earnings and really putting GAAP forward because it is what the short-term market is requesting right now from company. The market is very, very short-sighted. And so when I look at their guidance, I think this is yet another company succumbing to Wall Street's desire for short-term GAAP profitability, not economic profit, right? Not economic profitability. We're talking about GAAP profitability here. That's all Wall Street. That's all these algorithms care about. And so because of that, Crowdstrike only guided 34% revenue growth. And this is obviously very sandbagged, which is why I'm putting the higher end here. And I'm like, come on, Crowdstrike. Why do you sandbag your guidance like that, right? When I extrapolate it and look at quarter over quarter and I just extrapolate that, I'm getting 44% and you're guiding 34%. Well, they're setting themselves up for positive upside because they're probably tired of their stock getting battered after, quarter after quarter, even though they really did nothing but the best, right? They are best in class company. They have the best performance out there. They're the best in their sector. And to me, and this is all too familiar for so many companies, right? Like, 2 weeks ago, I reported on Palantir. Palantir was the same thing. They weren't supposed to have GAAP profitability until 2025. They had to move it forward and stop investing in their growth. Well, this is kind of the same thing that I hope is not happening to Crowdstrike, but it's taking that direction where we're sacrificing the strategic imperative of top-line growth, which is what I think is the most important thing: market share, gaining more customers, more people to sign up for more products, more offerings, and they're kind of sacrificing that for short-term financial pressure of GAAP profitability, which they didn't need to do. This company was cash flow positive for 4 quarters in a row, and they have $2.7 billion on cash on the balance sheet. They absolutely don't need to bring profitability forward. The reason why they're doing this is because Wall Street is demanding it and pressuring it and, punishes stock prices that don't have GAAP profitability, although that has no strategic implications for the business, right? The business is still doing so well. And so who knows if they had kept their sales teams, kept investing in sales, kept investing in R&D, I have little doubt that we would have had closer to 50% growth if they had kept investing in the actual strategic imperatives instead of focusing on that margin and reducing the operating costs. It's something that I have a hard time understanding, as you probably know if you follow the channel. So again, I would rather see them spend more on acquiring new customers. These are recurring revenue customers. So you can spend money to acquire customers right now, especially when things like advertising is cheap right now. The labor market is getting cheaper. A lot of people are getting laid off. Like, this is the moment to go and spend and invest and acquire more customers to double down on your advantage, right? Also, R&D, although R&D is very important. It's kind of important spend. And although I don't think they're going to reduce that much R&D for a company like CrowdStrike, I want to see them spend more on the business and the strategic imperatives of the business. Like right now, this is an early business. This is a young business. They need to invest. So again, I'm kind of being facetious here, but why CrowdStrike? Let me ask you, CrowdStrike, why are you in such a hurry to pay taxes, right? It's only today's market. It's only the pressure from the Wall Street shareholder base who can't stand the stock being down, right? Due to short-term concerns. Oh, sell the stock. They don't have GAAP profitability. But me, that doesn't faze me. A stock could be down for 2 or 3 years. I don't care. That really doesn't faze me. And so it's like, there you go. So that's what they're doing. So now they're focusing on earnings per share. They're guiding really high GAAP profitability of 2.39 earnings per share in 2024. So that'd be a forward PE right now of 51 for a company which I believe has the potential to grow near 50%, right? My estimate, if you remember, is 44% here. I believe this company has the ability to grow near 50%, right? For many, many years to come. So this is cheap, actually. This is actually cheap. And who knows, like you may even have people on Wall Street saying, this is an awful PE ratio. You can buy a bank for 6 PE. Well, guess what? A bank is not going to grow as fast as CrowdStrike. Anyways, I feel like they're showing off their earnings power to Wall Street. And because they're doing that, because they're playing the Wall Street the game of showing up EPS GAAP earnings, their stock will re-rate, and it will re-rate up, and then the buying window will close. So I've been buying CrowdStrike consistently over the past few months, and I'm very, very happy that the stock has been down. And this is great news, by the way. If you have a full position and you weren't planning on adding more, this is great news. Me, I'm a net buyer of stock. Probably for another 2 decades. So it's like, but if you're close to retirement, this is great news. But anyways, and we know this is, how do you increase GAAP profitability? How do you achieve GAAP profitability? Well, look what the CFO says, right? The CFO is talking about continuing thoughtful, disciplined investing in innovation and market share expansion. So I like that, I think it's good to have thoughtful and disciplined, not waste any money. But a company like CrowdStrike was never wasting money on things, like I don't know, like dining rooms at Twitter, or a day in the life of CrowdStrike employee videos. That was not a thing, right? You could argue a lot of a capex or OPEX for say Google or for Twitter, that was frivolous OPEX, but not for a company like CrowdStrike. They've been a high performer. So what that means essentially is they're going to decrease spend on the strategic imperatives a little bit in order to show profit, to re-rate the stock, and I think they're caving, and they're caving to the pressure of short term. But that's okay. That's okay because the growth is still so high. And even though I would have liked them to keep focusing on market share growth and growth, I understand that in the current macro, maybe employees are depressed, the stock price being down. There's a lot of reasons going on why they would cater to the short-term pressures. But, CrowdStrike has competition. Like, it's not like it can fall asleep and stop investing, which is why I guess I'm glad to see them stop and keep investing. But, they have competition. They have Microsoft, right? It's the classic big tech against new tech, right? Microsoft as a product. Sentinel-1, well, Sentinel-1 is a, I would argue, not as strong, but Sentinel-1 is definitely a competitor. They have competition. It's like they need to defend that market share. And when you have a leading market share, it's typically a good strategy to triple down, right? When you have almost $3 billion of cash on the balance sheet, when you have strong cash flow, hundreds of millions of positive cash flow each quarter, right? It's a good idea to triple down on your advantage, right? Ad space is cheap right now, right? If I look at some of my companies that I'm very, very, very happy with, and I'm happy with CrowdStrike, I just want to say. But if you look what HIMS is doing right now, HIMS is investing heavily in ad space. And while other retreats and competitors retreat, they're promoting their product left and right on the internet. This is the moment to grab market share when everybody else stops spending, right? Tesla is kind of the same way. They're literally flooding the world with inexpensive EVs while other automakers cope with the debt that they have and cope with investments in the tens of billions of dollars. So you can cement your market share in times of crisis, and it appears that they're going to be doing some of that. I would have just liked to see them do more of that. And let me conclude by saying that I am done nitpicking. I realize this may sound like nitpicking, but I am done nitpicking. The guidance of 34% sales growth is outstanding. It's, how many times the S&P 500, I can't even think. I think the S&P 500 is going to have negative sales growth. So this is outstanding. This is well above my threshold of 30%. I believe they're going to be much closer to between 40 and 50% per my estimate of 44%, which would be even more outstanding. And I believe the stock will re-rate higher. Which is why we've been blessed and lucky over the past few months with the opportunities that we've had to buy the stock. I believe it will re-rate higher as it is showing GAAP profitability, and Wall Street right now, that's all they care about and all they focus on, the short term, the next 12 months. And I'll conclude by, I know a lot of my viewers like to talk about moats, and Crowdstrike really has the network and the data from the network that gives them a moat. And so I believe they may have achieved kind of an escape velocity where it's going to be very, very hard for another company to acquire a network of users and collect data as quickly and as relevant the data, the quality of that data, as Crowdstrike, because the way Crowdstrike works with its snowball or its flywheel is, the more customers they get, the more data they get, the better is their AI, and the better is your AI. The more customers, the more data, the better your AI. It's kind of the traditional view of a lot of AI companies right now is, yes, competitive advantage comes from how much data you have. And Crowdstrike has the most data, which means that whenever there's a breach in that network, not only it teaches your AI to catch that threat faster than everybody else, because you have access to greater amount of nodes, greater points, data points in the network. And it also increases the ability of your AI to identify threats because your AI is trained on more data. And there is a point to be made that Crowdstrike has achieved a level of data that competitors are going to have a very, very hard time to catch up on. Kind of the same analogy as one could make with Tesla's self-driving feature. They have data since 2012 that they've been recording, and it will be very hard for anybody to collect as much data as Tesla. I believe Crowdstrike is kind of in a similar situation, so they have a strong modern moat protecting their business, which may also allow them to be a little more relaxed when it comes to growth and just show Wall Street what it wants, which is short-term GAAP earnings, which mean not much. What means a lot is cash flow. What means a lot is strategic positioning. What means a lot is revenue growth. Anyways, I am done. This is not investment advice, of course. This is just entertainment. Thank you for watching. Please like, please subscribe, and I appreciate all of your comments, and thank you for watching my channel. Have a great day.